Before the Great Depression, 6 warning indicators appeared: exposed, measurable, on record. Then came Black Tuesday. I overlaid those metrics on today. Every single one is flashing. These aren't predictions, just numbers. 2 errors side by side. You see the evidence. You make the call. Starting now, there is a number that appeared in September 1929. It just appeared again. Not approximately. Not in the way pundits say history rhymes. I mean the exact structural signature. The same ratio, the same conditions, the same blind confidence surrounding it. Surfaced in financial data in early 2025, and almost nobody reacted. That number is the Shiller-Cape ratio. In September 1929, it hit 32.6. That was the peak. Within weeks, the Dow began its collapse, an 89% erasure that would take 25 years to recover. In early 2025, the Cape breached 37, higher than the 1929 peak, and the financial press called it a sign of strength. I used to think 1929 was a different world, an immature market, unsophisticated investors, a young Federal Reserve still learning its tools. That's what I was taught. That's what most of us absorbed, this comforting narrative that the Great Depression was a one-time malfunction in an early-stage system, a primitive failure we've since engineered away. I believed that for years. Then I started comparing the actual numbers, not the narratives, not the interpretations, the raw structural data. And what I found made the narratives irrelevant. Margin debt in the late 1920s, the amount of borrowed money poured into stocks, reached roughly $8.5 billion at its peak. Adjusted for inflation, that's approximately $140 billion. It was considered an insane, unprecedented level of speculative leverage, the kind of excess that couldn't happen again because we'd learned the lesson. By late 2024, NYSE margin debt had surpassed $815 billion, not adjusted, nominal. We didn't just repeat the leverage, we multiplied it nearly 6 times over in real terms, and we gave it a different name: securities-based lending, portfolio margin, options convexity. The vocabulary changed. The mathematics didn't. I kept pulling threads. Wealth concentration in 1929. The top 1% held approximately 44.2% of national wealth. That was the Gilded Age peak, the number economists point to as the unsustainable extreme that preceded financial and social rupture. In 2025, Federal Reserve distributional data shows the top 1% holding roughly 32.3% of total net worth. Sounds lower, sounds safer, until you account for asset class distortions, private equity valuations, unrealized gains, offshore holdings that systematically undercount wealth at the top. When researchers adjust for these gaps, the trajectory curves directly toward 1929 levels. We are not at the peak yet. We are on the slope, climbing the same incline, at the same angle. The pattern didn't break with one metric or two. It held across every dimension I checked: valuation ratios, leverage levels, wealth concentration, and then I hit the one that made my stomach drop. The Smoot-Hawley Tariff Act was signed on June 17, 1930. It imposed aggressive tariffs on over 20,000 imported goods. Economists almost universally agree it deepened the depression by collapsing global trade, triggering retaliation, and destroying cooperative frameworks that might have cushioned the downturn. It was protectionism born of economic anxiety, sold as national strength, implemented as self-destruction. In 2024 and 2025, I watched an escalating tariff regime unfold, not as historical curiosity, but as active policy. The rhetoric is different. The mechanism is identical. Tariffs on strategic imports, retaliatory spirals, trade partners diversifying away from the dollar. The sequence is running again, and the people running it either don't know the history or believe they are exempt from it. Here is where I need you to understand something about how crashes actually work, because the popular version is wrong. The popular version says a shock hits the market, panic spreads, prices fall. That is not what happened in 1929. What happened was a system engineered to amplify gains on the way up and amplify destruction on the way down. The broker call loan system allowed investors to buy stocks with as little as 10% down. The rest was borrowed from brokers, who borrowed from banks, who borrowed from the Federal Reserve. When prices rose, everyone profited. When prices fell, margin calls cascaded. Brokers forced sales, which drove prices lower, which triggered more calls, which forced more sales. The architecture was reflexive. It didn't just fail, it accelerated its own failure. Today, the architecture is more complex but structurally identical. Securities-based lending lets high-net-worth investors borrow against their portfolios without selling. No taxable event, no reduction in exposure, pure leverage stacked on existing positions. Options volume has exploded. Zero-day to expiry contracts now account for over 50% of S&P 500 options activity on peak trading days, creating a derivatives layer that market makers must hedge in real time, amplifying every move in both directions. The broker call loan didn't disappear. It evolved, it got faster, it got bigger, and it got renamed so that we wouldn't recognize it. How many of these indicators need to match before you stop calling it coincidence? 3, 4. I've shown you 5, and I haven't even touched the Federal Reserve yet. I haven't mentioned the credit cycle or the debt ratios. Those are coming. What I need you to sit with right now is simpler and worse. The same mathematical preconditions that produced the largest financial collapse in modern history are not approaching. They are here. They are measurable. They are published in quarterly reports that almost no one reads because the market is at all-time highs, and all-time highs feel like safety. They felt like safety in August 1929 too. If you hold equities right now, if your retirement, your savings, your future is denominated in assets trading at these valuations, at this leverage, inside this architecture, you are sitting in the same seat, in the same theater, in the same act. The only difference is the lighting is better and the program has a glossier cover. The play hasn't changed. I know how this act ends, not because I'm predicting anything, because I've read the script before. It was written in 1929, and the numbers tell me with uncomfortable mechanical precision that we are performing it again. I used to believe the Federal Reserve was a stabilizer, a technocratic guardian designed to smooth the violent cycles that had plagued the American economy before its creation in 1913. That belief survived my education, my early career, most of my adult life. Then I stopped reading summaries and went to the primary sources, the actual Fed meeting minutes from 1928, the rate decisions, the internal debates. What I found was not a stabilizer. What I found was the detonator. In 1928, the Federal Reserve began raising interest rates to curb speculative excess. The margin mania, the broker call loans, the runaway leverage I described. On paper, responsible policy. In practice, striking a match in a room saturated with gasoline. The rate increases didn't just cool speculation. They contracted credit across the entire economy. Businesses couldn't roll over short-term loans. Banks that had extended themselves into the market began pulling back simultaneously. The tightening didn't prevent the crash. It manufactured the precise conditions under which the crash became unsurvivable. The Fed didn't fail to stop 1929. The Fed built 1929, first by enabling the leverage on the way up, then by detonating it on the way down. Hold two timelines in your mind simultaneously. In 2022, the Federal Reserve launched its most aggressive rate hiking cycle since Paul Volcker in 1980, 0% to 5.25% in 16 months. The stated reason was inflation, itself a direct consequence of the trillions the Fed had injected during 2020 and 2021. The same institution that manufactured the distortion was now tightening into the fragility it had produced. Inflate, then contract. Enable, then detonate. 94 years apart, and the institutional logic had not shifted by a single degree. I stared at those two timelines until the gap between them disappeared. It didn't take long. This is not incompetence. This is architecture. The Federal Reserve operates under a dual mandate: maximize employment and maintain price stability. In a financialized economy, these two objectives are structurally contradictory. To stimulate employment in a downturn, the Fed floods the system with cheap credit. Cheap credit inflates asset prices. Inflated assets create wealth effects, encourage speculation, and generate leverage accumulation at every tier of the financial system. When inflation inevitably arrives, and it must, because that is the mathematical consequence of monetary expansion, the Fed is forced to tighten. Tightening into a leverage system does not produce gentle cooling. It produces fracture. The mandate itself is a machine that manufactures bubbles and then punctures them. It has no other operational mode. I used to think this was a flaw. Now I understand it is the design. I thought the system had learned something permanent after 1929, and for a while, it seemed like it had. The Glass-Steagall Act of 1933 was the single most important structural reform in American financial history. It separated commercial banking from investment banking, a legal firewall that prevented depositor money from being used as fuel for speculative bets. For 66 years, that wall held. It was not perfect, but it enforced a principle so basic it shouldn't have needed legislation. The money you use to buy groceries should not occupy the same pool as the money someone else uses to short copper futures or lever into mortgage-backed securities. Glass-Steagall was the lesson of 1929 made into law. It was the one thing I pointed to as evidence that the system could learn. On November 12, 1999, President Clinton signed the Gramm-Leach-Bliley Act, and the wall came down. Commercial banks, investment banks, and insurance companies could now merge, cross-sell, and commingle funds without restriction. The structural separation built from the ashes of the Great Depression was erased in a single piece of legislation, passed with bipartisan enthusiasm, championed by the very institutions it had been designed to restrain. The argument was that modern markets were sophisticated enough to self-regulate. 9 years later, in September 2008, the world discovered exactly how well sophisticated markets self-regulate. But here is the part that changed how I see all of this. After 2008, Glass-Steagall was not reinstated. The Dodd-Frank Act added complexity, but not separation. The lesson was learned, then unlearned, and then the unlearning was codified as permanent policy. That sequence is not an accident. It is a signal. If the firewall built after 1929 was deliberately removed in 1999 and was not rebuilt after the worst financial crisis in 80 years, what exactly do you think is protecting you now? I spent months looking for the answer. What I found was not a better system. It was a more opaque one. Complexity substituted for transparency. Distributed risk substituted for contained risk. The primary instrument of that substitution is the global derivatives market. As of 2024, the Bank for International Settlements estimates total derivatives notional value at approximately $667 trillion. That is not a misprint. 667 trillion, roughly 6 times global GDP. In 1929, equivalent leverage instruments, broker call loans and investment trusts, represented approximately 1.5 times GDP. We didn't reduce leverage after learning the lesson. We multiplied it by a factor of 4 and dispersed it across counterparties in 40 countries so that no single regulator could see the whole picture. Beneath all of it sits the Federal Reserve's balance sheet, the silent engine powering every market you interact with. In 2008, total Fed assets were approximately $900 billion. By the peak in early 2022, that figure had reached $8.9 trillion. $8 trillion in synthetic liquidity, conjured from nothing, injected through bond purchases that suppressed interest rates and inflated every asset class simultaneously. Stocks, bonds, real estate, cryptocurrency, everything rose together because everything was drinking from the same artificial well. That is not a market. That is a life support system. And life support systems have a feature that healthy organisms do not. When you remove them, the patient doesn't gradually adjust. The patient codes. The mechanism that connects all of this, leverage, the Fed, derivatives, the absence of structural firewalls, has a name. Irving Fisher identified it in 1933, writing from inside the wreckage of the very collapse it described. He called it debt deflation. Decades later, George Soros formalized a related framework he called reflexivity. The core principle is identical. Rising asset prices generate more collateral enables more borrowing drives prices higher. The loop is self-reinforcing on the way up. It feels like prosperity. It registers as growth on every dashboard. Every metric confirms the expansion. Then, at the moment of reversal, a rate hike, a credit event, a sudden loss of confidence, the same engine runs in reverse with equal force. Falling prices destroy collateral. Destroyed collateral triggers forced liquidation. Liquidation drives prices lower still. The amplification is perfectly symmetric. The euphoria and the destruction are produced by the same machine, running in opposite directions. Every investor alive today has been trained inside this system. We have never operated in a normal interest rate environment. We have never experienced a market without a central bank backstop ready to intervene at the first sign of serious decline. We don't recognize normal because we have never lived in it. The baseline we measure everything against, 15 years of near-zero rates, expanding balance sheets, reflexive asset inflation, is not the foundation. It is the anomaly. It is the distortion. We have mistaken the most artificially inflated financial environment in human history for solid ground, and we have built retirement plans and mortgages and entire life architectures on top of it. The leverage is not hidden. The Fed publishes its balance sheet every Thursday. The BIS reports derivatives data quarterly. Margin debt figures arrive monthly. Every number I have cited is public, verified, accessible to anyone with an internet connection. The reason none of it triggers alarm is not concealment, it is scale. 1 trillion is an abstraction. 8 trillion is a policy decision. 667 trillion is a figure so large it slides off the surface of human cognition without creating friction. But it is not an abstraction. It is a contractual web binding every major financial institution on Earth. And when I trace the architecture of that web, its nodes, its dependencies, its reflexive feedback loops, I find the same structure, the same leverage mechanics, the same absent firewalls that existed in 1929. Only now they are scaled to a magnitude that makes the Great Depression look like a regional banking incident. I mapped the intervals between crises, not casually, obsessively. I built a timeline on my office wall, pinned every major financial collapse since 1929 in sequence, measured the gaps. At first, I was looking for irregularity, some evidence of randomness that would let me dismiss the pattern as coincidence. Instead, I found compression. The gaps are shrinking, the amplitudes are growing, and the fiscal capacity available to absorb each impact is deteriorating at a rate that follows its own merciless curve. The math doesn't argue, it doesn't reassure, it just counts down. From the 1929 crash to Black Monday in 1987, 58 years. From Black Monday to the dot-com collapse in 2000, 13 years. From dot-com to the global financial crisis in 2008, 8 years. From 2008 to the pandemic liquidation of March 2020, 12 years. You could argue that last interval broke the pattern. 12 is larger than 8. For a brief moment, staring at that gap, I felt relief. Then I looked at what filled those 12 years. The largest monetary expansion in human history. A central bank balance sheet that grew by $8 trillion, interest rates pinned at zero for 7 consecutive years. The interval didn't lengthen because the system healed. The interval lengthened because the Federal Reserve injected a dose of synthetic stability so massive it delayed the next fracture by buying time with borrowed reality. The patient didn't recover. The patient was put on a ventilator and told to run a marathon. The Dow Jones Industrial Average peaked at 381.17 on September 3, 1929. By July 8, 1932, it had fallen to 41.22. 89% gone. Not in a flash, in a slow, grinding 34-month descent that destroyed savings, collapsed banks, and rewired the psychology of an entire generation. The index did not return to its pre-crash level until November 23, 1954. 25 years of recovery. A quarter century during which anyone who had been fully invested at the peak and who hadn't been wiped out by margin calls sat underwater, watching the world rebuild around the ruins of their financial lives. That is not a correction. That is a generational erasure. I need you to hold that 25-year recovery in your mind while I show you what happened to the system's fiscal immune response across each subsequent crisis. In 1929, U.S. federal debt to GDP stood at approximately 16%. The government had enormous capacity to borrow, spend, and absorb. By the time the dot-com bubble burst in 2000, debt to GDP had risen to 33%, still manageable. When Lehman Brothers collapsed in September 2008, it was 63%. When COVID hit in March 2020, it was 98%. As of 2025, it sits at approximately 124%. Do you see the trajectory? Each crisis arrives with less room to respond than the last. The fire keeps getting larger and the water supply keeps shrinking. This is not a metaphor. This is arithmetic. The most dangerous kind of arithmetic because it is boring enough to ignore and irreversible enough to destroy everything. The 2020 pandemic response was the most aggressive fiscal and monetary intervention in recorded history. Approximately $5.2 trillion in direct fiscal stimulus, checks, loans, grants, unemployment extensions, pumped into the economy in under 18 months. Simultaneously, the Federal Reserve purchased $4.6 trillion in assets between March 2020 and March 2022, absorbing treasuries and mortgage-backed securities at a pace that would have been considered hallucinatory a decade earlier. Combined, that is roughly $9.8 trillion in intervention, a figure larger than the entire GDP of Japan, the third largest economy on Earth. Injected in 24 months. The sheer scale should have been alarming. Instead, it was celebrated. Markets recovered in 5 months. The narrative became one of resilience, of innovation, of proof that the system works. But the system didn't work. The system was overridden. There is a critical difference between a machine that absorbs a shock and a machine that is manually held together while the shock passes. In the first case, you gain confidence in the machine. In the second case, you should be examining the hands that held it together and asking whether they can do it again, harder, longer, with less leverage. That question has a measurable answer, and the answer is devastating. Your retirement account, your home equity, your savings, they are all denominated in the same instrument that was diluted by nearly $10 trillion to produce the appearance of recovery. You didn't get richer during the post-2020 rally. The unit of measurement got smaller. The number on your statement went up because the value of each unit went down. You are being paid in a currency that is confessing its own deterioration in real time, through grocery prices, through insurance premiums, through the gap between what your salary buys today versus what it bought in 2019. This brings me to the mechanism that guarantees each cycle produces a larger successor. It has a clinical name, moral hazard, but that term is too sterile for what it actually does. In practice, it functions as a ratchet. In 1998, when long-term capital management collapsed, the Fed orchestrated a private bailout and cut rates to cushion the fallout. Alan Greenspan's implicit message to markets was clear. If you are large enough and interconnected enough, you will not be allowed to fail. Markets heard this. They responded rationally. They took more risk. The Greenspan put became the Bernanke put when, in 2008, the Federal Reserve bailed out Bear Stearns, facilitated the rescue of AIG, and launched quantitative easing at a scale previously unthinkable. The message amplified. Not only will you be saved, you will be saved with free money. Markets heard this too. They responded by leveraging further, reaching further, building structures of greater complexity and fragility. Then came 2020 and the Powell put. Unlimited quantitative easing announced on March 23rd, with no cap, no ceiling, no constraint. The final inhibition removed. The last signal that there were boundaries in the system, erased in a single press conference. Each put teaches the same lesson. Risk is privatized on the way up and socialized on the way down. Gains belong to investors. Losses belong to the public, denominated in currency debasement, purchasing power erosion, and generational debt. This is not conspiracy. It is incentive structure. When you guarantee rescue, you guarantee escalation. When you guarantee escalation, you guarantee a crisis that exceeds your capacity to rescue. The ratchet only turns one direction. If each rescue requires more money than the last, and the money itself is losing credibility, what rescues the rescuer? I spent a long time looking for the answer. I looked at the Fed's toolkit: rate cuts, quantitative easing, emergency lending facilities, dollar swap lines. Every tool assumes that the dollar itself retains confidence. Every tool assumes that treasury bonds remain the global risk-free asset. Every tool assumes that the United States government can borrow at reasonable rates without limit. In 2025, the US is paying over $1 trillion annually in net interest on its federal debt, more than it spends on national defense. Interest expense is now the fastest-growing item in the federal budget, and rates have not even returned to their historical averages. The tools are not broken yet, but they are consuming the hand that holds them. U.S. household debt reached $17.94 trillion in the third quarter of 2024, according to the Federal Reserve Bank of New York. In inflation-adjusted terms, this exceeds the peak levels recorded before the 2008 crisis, the crisis that was caused by household debt. Auto loan delinquencies are climbing. Credit card balances have surpassed their historical peak. The consumer is not deleveraging. The consumer is reloading the same weapon that fired in 2008. And this time, the housing market, the stock market, and the government balance sheet are all simultaneously stretched. In every previous cycle, at least one of these pillars was strong enough to absorb the shock from the others. I cannot find that pillar now. I have looked. The sequence is accelerating. The intervals are compressing. The scale of each crisis and each rescue is expanding exponentially, and the fiscal, monetary, and political capacity to respond is contracting with each iteration. These trajectories are converging toward an intersection point, a moment where the required intervention exceeds the system's ability to deliver it without destroying the currency in which the intervention is denominated. The next number on this sequence is not a market crash. It is not a recession. It is not a banking crisis. It is something we haven't had a word for yet. A failure not of a market within the system, but of the system itself. The monetary architecture, the foundational agreement that the numbers on the screen represent something real. Every previous crisis tested the structure. The next one tests the foundation. And foundations, once fractured, do not dip and recover. They give way all at once, without warning, because the warning was the decade of stress that everyone reinterpreted as strength. Reinterpreted as strength. That phrase kept circling in my mind for months after I first wrote it down, because it described not just a financial phenomenon, but a cognitive one, a systematic inversion of meaning so complete that every signal of danger registers as confirmation of safety. I went looking for the moment this inversion began. I went looking for the origin point, the first fracture in the relationship between what the numbers say and what the numbers mean. I found it. It was 1913, and the instrument was not a policy or a regulation. It was the unit of measurement itself. The US dollar has lost approximately 96.7% of its purchasing power since the Federal Reserve was established in December 1913. Bureau of Labor Statistics (CPI) data confirms this with mechanical indifference. What cost $1 in 1913 requires over $30 today. This is not a controversial statistic. It is not disputed by any credible economist. It is simply ignored because acknowledging it would require confronting a conclusion that dismantles the foundational assumption of every financial plan, every retirement model, every salary negotiation in the modern economy. The unit we use to measure wealth is itself decaying, not occasionally, not in crises, continuously, by design. Inflation is not a malfunction of the monetary system. Inflation is the monetary system. The Federal Reserve targets 2% annual inflation as policy, which means the institution responsible for the currency has an explicit, stated goal of making that currency worth less every year. I used to think this was a technical necessity. Now I see it for what it is: a slow-motion transfer mechanism so gradual that no generation experiences enough of the decline to revolt against it. You have been measuring your wealth with a ruler that shrinks every year, and you call the number getting bigger growth. This is not a metaphor. This is the operational reality of every portfolio statement, every GDP report, every wage increase announced with fanfare and absorbed with quiet disappointment when the grocery bill arrives. The S&P 500 is at all-time highs, measured in what? In dollars that have lost 96% of their value. Priced in gold, the one monetary instrument no central bank can print, the S&P 500's performance over the last 25 years tells a radically different story. Priced in real assets, in energy, in hours of labor required to purchase basic necessities, the growth narrative fractures. But nobody prices anything in those terms because the dashboard was not built to reveal. The dashboard was built to reassure. This is where Goodhart's law completes the trap. Charles Goodhart, a former Bank of England advisor, articulated a principle in 1975 that should be tattooed on the forehead of every policymaker and financial analyst alive. When a measure becomes a target, it ceases to be a good measure. GDP is targeted. So government spending is added directly to the numerator. Borrow $1 trillion, spend it, and GDP rises by $1 trillion regardless of whether anything productive was created. The unemployment rate is targeted, so the denominator is adjusted. The labor force participation rate has fallen from 67.3% in January 2000 to 62.6% in early 2025. Roughly 11.7 million working-age adults simply disappeared from the calculation. They are not counted as unemployed. They are not counted at all. The rate looks healthy because the people who would make it look sick have been statistically removed from existence. The Consumer Price Index is targeted, so its methodology has been revised repeatedly since the early 1980s. Hedonic adjustments, substitution effects, geometric weighting, each revision producing a lower number than the previous methodology would have generated. If CPI were still calculated using the 1980 methodology, current inflation estimates would be roughly 3 to 4 percentage points higher than officially reported. The dashboard doesn't reflect the economy. The dashboard is the product being sold. And every metric you use to feel safe, the GDP growth number, the unemployment rate, the inflation figure, the stock market index, has been structurally gamed to produce that feeling of safety, not through conspiracy, through incentive. Every institution benefits from the numbers looking good. No institution benefits from the numbers looking true. If every metric you use to feel safe has been engineered to make you feel safe, how would you ever know you are in danger? This is the question I cannot escape. Because it has no comfortable answer. The instruments are compromised. The people reading the instruments are trained to trust them, and the institutions that built the instruments have no incentive to recalibrate them toward accuracy, because accuracy would trigger the very panic they exist to prevent. The system is not failing to warn us. The system is succeeding at preventing warnings. Central banks know this, not theoretically, operationally. In 2023, global central bank gold purchases hit 1,037 tons, according to the World Gold Council, the highest level in modern recorded history. Central banks, the very institutions that issue fiat currency, that tell you the dollar and the euro and the yen are sound, are accumulating the one asset that represents a hedge against the failure of fiat currency. They are buying insurance against themselves. This is not a signal I am interpreting. This is an action. Gold doesn't pay dividends. It doesn't generate yield. The only reason to accumulate it at this pace is a belief, held by the institutions that control the money supply, that the money supply itself may not hold. Meanwhile, the corporate sector has been engaged in its own form of measurement distortion. S&P 500 companies spent over $6.3 trillion on stock buybacks between 2012 and 2024. Buybacks reduce share count, which mechanically increases earnings per share even when actual earnings are flat or declining. A company that earns the same profit but has fewer shares outstanding appears to be growing. It is not growing. It is shrinking its denominator. The same trick the unemployment rate uses: remove the units that make the number look bad, and the number looks good. Revenue growth across the S&P 500 has been structurally stagnant for over a decade when adjusted for inflation and buyback distortion. What you see on the screen is not growth. It is financial engineering performed by corporations borrowing at artificially suppressed interest rates to purchase their own shares to inflate the metric that determines executive compensation. The incentive loop is closed. The feedback mechanism is sealed, and your retirement fund is valued based on the output of that mechanism. The economy is fundamentally sound. Those words were spoken by Treasury Secretary Andrew Mellon in 1929, weeks before the cascade began. They were echoed by Hank Paulson in 2008, months before Lehman Brothers disintegrated. They have been repeated in various forms throughout 2024 and 2025 by officials whose institutional function requires them to say exactly that, regardless of the underlying conditions. I used to interpret those reassurances as information. Now I read them as counter-indicators, data points on a timing chart. The frequency and intensity of official reassurance correlates inversely with structural stability. The louder they insist the system is sound, the closer the system is to proving them wrong. This is not cynicism. This is the historical record, exposed and pattern-matched across a century of identical sequences. I went looking for the moment it started going wrong, and I found a loop, not a line. 1929 was not an event. It was a prototype, the first full execution of a sequence that has since run 4 more times with increasing scale and decreasing recovery capacity. Leverage builds, speculation saturates, a tightening trigger fires, cascade failure follows. Then rescue, each rescue larger than the last, each rescue financed by diluting the currency, each dilution reducing the system's capacity to rescue again. The pattern is not something that happens to the system. The pattern is the system. Financial resets are not bugs. They are the operating system executing as designed. Every rally is a loading phase. Every reassurance is a counter-indicator. Every utterance of this time is different, is the final data point confirming that it is not. The pattern has completed before. It will complete again. The architecture guarantees it. The leverage, the reflexivity, the absent firewalls, the compromised metrics, the mandate contradictions, the moral hazard ratchet. None of these have been removed. All of them have been scaled. The question was never if. The question was only what you hold when the sequence completes, and whether you recognize the sequence before it recognizes you. I spent 2 years assembling this picture, hoping to find a flaw in the pattern, a break in the chain, a single structural reason to believe the outcome could be different this time. I did not find one. The numbers are the numbers. The architecture is the architecture. And the clock, indifferent to opinion, to hope, to the glossy confidence of a market at all-time highs, continues to count down toward the same destination it has reached every time before. The only variable left is not whether the destination exists. It is whether you arrive there aware or asleep. That choice, at least, is still yours.